So the last two objectives we look at today look at reporting as well as analyzing cash. So let's start with reporting of cash. Now, cash can take many forms. Cash can be the cash in your wallet. It can be cash that people keep in other ways. So if we go back many years, people used to use traveler's checks before you could take your credit cards and use them overseas. So they would take a traveler's check to a hotel overseas. The hotel would check your ID and therefore would then issue you the cash associated with the traveler's check. So they would take the traveler's check away from you so they could then get the funds associated with that, and they will give you cash associated with that traveler's check. Now, people keep cash in many different forms. And so businesses, similarly to this, also keep cash in different forms, and they need a way of reporting the cash that they have on hand. So you'll find in many financial reports, there is terminology called cash and cash equivalents. So basically a cash equivalent is any investment that is readily convertible into a known amount of cash and has a maturity of less than 3 months, so fairly short term. So you'll often find this in the balance sheet that there is cash and cash equivalents, and you are provided with a number or set of numbers associated with that. Sometimes firms have cash in different accounts for specific purposes, and so therefore they will deem that as a cash equivalent because, as I said, it is readily convertible to cash in less than 3 months. So in terms of why businesses might restrict cash for different purposes, so sometimes businesses might restrict it for paying interest or other contingent liabilities that may arise in the future, and so they deem that cash to be associated with a particular type of use, and so therefore a particular type of account in their records. Now, let's move on and let's have a look at learning objective number 5, which is analyzing cash. So what we're looking at doing here is how to analyze cash in terms of looking at how well the business is managing its cash. Now, some of you think about cash as to what you've got in your wallet. Some people manage their cash by keeping it in a box under the bed, although that's not recommended. I know my mechanic was looking at purchasing an old Toyota Corolla that was found in the garage in a deceased estate, and they didn't have the keys available for it. So he said to the executive of the estate to find the key, and then he'd be happy to come back and look at the car in more detail. They found the key, opened the boot up, and they found $50,000 of cash stored in the boot of that car. So that's obviously where that person that passed away kept their cash. Not a great idea, but some people do have some weird and wonderful ways of keeping their cash. From a business perspective, we obviously need all cash reported in the financial statements, and so therefore that allows us to analyze it using some of the techniques that we've covered in this subject already. And those techniques are related to horizontal and vertical analysis. So with horizontal analysis, basically what you're looking at is change in cash holding over time. So whether cash has increased or decreased from the prior year. With vertical analysis, what you're looking at is what proportion of cash you have compared to your total assets in a business. So for example, if we look at CSL here, it shows from 2016 to 2017, they had a substantial increase in their cash holding. It increased from $557 million to $846 million. So a 51.9% increase in cash. That is massive. We can also see similarly that the proportion of cash to total assets increased from 2016 to 2017 as part of the vertical analysis. So there's a proportion for 2016, 7.4%. And there's a proportion for 2017, 9.3%. So my question to you right now is this good that they've increased their cash balance by so much over this 12-month period? Well, the answer to the question that I've just asked you will depend on your perspective. There's no right or wrong answer here, but there are good and less good ways to manage businesses. Now, generally having a lot of cash on hand is great because you can pay off all bills as they fall due, and therefore you don't need to worry about that. And there's less risk because the business can pay off all the liabilities as they fall due. But what it means is that that cash that's sitting there is probably not earning your business a lot of money. So think about it. If you put cash in an interest-bearing account, how much does that actually earn? So if I have a look at Commonwealth Bank's term deposit rates here we have a special offer on term deposit rates and fees of 1.3% per annum if you lock your cash in for 8 months, or 1.7% if you lock it in for 12 months. To be honest with you, it doesn't seem that special to me. So what this basically means is you put $1,000 in a 12-month term deposit with Commonwealth Bank, you would earn $17 in interest over that year. It's not great, is it? So what that means in the current context with very low interest rates, given what economic events and effects have occurred as a result of the coronavirus, you will earn very little from having large cash holdings. So the question is, are there better uses of this cash holding to earn more money in other investments? As a business owner and as a manager of your own finances, that's a question you need to answer for yourself. Now, if we delve into the cash position of CSL in more detail and we look at why their cash has changed in the way it has, why it has gone up significantly over the 12-month interval we look at, we see that CSL generated almost 1.3 billion in cash from operations during 2017, which was little more than 2016. So their operational cash flows seem to be fairly stable, which means the cash change needs to be coming from investing and or financing activities. So moving on a bit further, we see that the majority of their outflow of cash was for payment of or purchase of property, plant and equipment. CSL repaid and borrowed substantially. So it borrowed $1.4 billion and repaid $600 million. Dividends were $600 million and share buybacks were over $300 million. So the majority of the outflow was from financing. So what this basically all means is you can see that they borrowed quite a lot and they repaid less. So where this cash flow is largely coming from is from financing activities. They've financed a lot more, they've borrowed a lot more, presumably to use for investment related activities like investing and improving the capacity of their property, plant and equipment, which is consistent with the cash outflows associated with this that I showed you at the top. So yes, they do have more cash on hand, but that cash has arisen because they have borrowed the cash. So while they have more cash, they also have more liabilities. So that's something you would need to consider when evaluating their overall cash position. And I assume if you look at the period going forward, they would have used that cash increase to fund property, plant and equipment purchases going forward, and therefore would have reduced that holding of cash accordingly. Now, one of the measures that help us analyze how successful a business manages its cash is what's called free cash flow. And basically what free cash flow shows us is the cash you have from operating activities, less capital expenditure, less dividend and buyback, which equals your free cash flow. So it gives you an indication as to how healthy the business's cash flows are from operations, and can it use that cash flow to improve capital, so capital expenditure here, as well as service its expectations from shareholders in terms of the returns they want going forward. And in this case, you can see that CSL's position from a free cash flow perspective over 2016 and 2017 is negative. And so therefore you would conclude based on that they cannot continue to invest so much money in capital expenditure and pay shareholders these sort of dividends because their cash flow from operations simply will not sustain that over long term. So again, this trend you see here of a negative cash flow, you should not expect that to continue to happen over the longer term in this case because it simply can't be sustained. Now this slide gives you a bit more details in terms of what I've just discussed and helps you to review the points I've just discussed in terms of CSL's cash movements. So make sure you read through that slide when you get a chance. So that's all for workshop number 5. Thank you for coming along again.